Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Glad you are with us. Myself and my co-host here. We're both financial advisors and been doing this for a long time and like to talk about... Our whole goal is to help people make wise choices with their money.
And
it's not about... This program's not about, oh, here's the latest, best investment.
And sometimes it's a forum for me to talk about things that are bothering me that I just don't understand. So this is how we're going to start the show today, if that's okay.
Perhaps.
Okay.
Is it somewhat related to the world of finance and investments?
Oh, no. It has everything to do with my cell phone. Yes, it's related
just making sure.
Finance and investing.
Well, you know.
Well, it just reminded me that I saw this article in the last couple of weeks. High earners age 50 and older are about to lose a major 401k tax break.
I saw that headline.
And then I read it, and then I thought, where's the simplification of the tax code? When exactly will this happen?
Pat, I'm in this business. I'm over 50. I read this article twice. I was still confused.
I was too. Yes.
Beginning next
year. Starting next year.
The article didn't explain it to me.
Well, yeah.
I'm waiting for our internal CPAs will.
Yeah, but it was a catch-up provision. But it brought back to me, Scott, that the tax code, it doesn't get any easier, and it changes constantly. It has become a political hammer.
Completely. Well, it has been for decades.
Yes, well, that's true.
But the whole financial planning, particularly if you've done well and have some assets, that tax side of things, that is more important than which company you're going to put in your portfolio.
It's as important as the asset class. As an asset class, it's very difficult to pick the right company.
That's why I use that example as opposed to asset class. Because
correct.
But it's as important as your asset allocation.
Yes, and it doesn't get any easier. It does not get any easier.
Well, in some ways it does because now there's technology.
Okay. I'm going to go with that
because it used to be. I mean, we've had financial planning tools forever, but there'd be a tax law change. You'd have to wait for an update, and
I'll take that
because there's so many phase outs.
Yeah, phase ins, phase outs.
Oh my gosh! Even like the SALT, it actually goes up to 40,000 beginning next year instead of 10,000. The SALT deduction.
Yeah,
but,
unless
your income is here and there,
and your
taxable tips, tax free, and your overtime. I mean,
Well, I was working with my daughter this year, and she's in law school, so she doesn't have a lot of income. So we did a bunch of Roth conversions from when she was a school teacher. But we did make a mistake. I thought she had some income last year, so I told her to make a Roth contribution at the beginning of the year. So we had to back it out, which was kind of a pain in the butt. So,
yeah, I didn't think you can recharacterize. Or was that just on a...
This was a Roth contribution.
Change on that or something.
No, we were able to. There was no penalty. Did we pay a penalty? I don't think we paid a penalty, but just... But my point
was how complicated.
And fortunately the tools are there. Maybe that's why it's become so complicated, is because the government realizes no one really complains about it anymore because the tools are there. Your accountant, it gives them a list of things, he or she, a list of things that they should be aware of when they're looking at your tax return.
Yeah, but it's so complicated that tax attorneys are employed because it's like, all right, the code says we can't go from A to F. We can't go a straight line from A to F. So the tax attorney says, that's fine. We're going to go instead from A to B to C to E to F. And if we do it in those steps, then we satisfy the requirement and we're able to do it.
Yes. That's correct. But the 401k was created
Like the backdoor Roth
Yes.
conversion. That's a prime example for the average person.
Okay.
Anyway.
Well, thanks for listening. I got that off my chest.
Yeah. All right.
But,
Well, why don't
we take calls here, right?
Yeah, why don't we take some calls? And we're in Arizona. And if you want to join us, we love taking calls, answering questions. The best way is to send us an email, questions@moneymatters.com. Questions@moneymatters.com. We're in Arizona talking with Josh. Josh, you're with Allworth's Money Matters.
Hello.
Hi, Josh.
I have a question on some certificates that I have. And they were my grandfather's, and he passed away, and they're from the 80s, and we kind of just found them. We were going through some paperwork, and we don't know quite what to do with them. We've contacted my financial advisor, and he connected me with the company he thought that was they were issued from, but turns out that it was a little bit difference in the name, and they said they never went under that name, so we're back to step one.
So they're stock certificates.
I don't think so. I don't believe so. There's at the top of them it says Fidelity Federal Savings and Loan Association Federal Security Certificates, and they're not.
And they're from. He was in his 80s, or they're from the 1980s.
They're from the 1980s, and he was in his 80s when he's passed, actually. But they're from the 80s, yes. And they're on the front of the certificates. There's 6 of them. The first one, certificate amount is $5,465.24. The interest rate is 14%. It has his name. It has certificate number. The date of the issue was October 7th, 1981. The maturity date, January 4th, 1982. And then it has his social for taxpayer ID.
Okay. The maturity date was a year later?
Yes. It has terms, and each one of them have terms that are like that on the backside of it. There's like another. They're in like these little.
I wonder if this had anything to do with Charles Keating.
Savings.
Where are
and
you
loan.
Loaded? Where are you located?
Arizona.
In Arizona.
Whereabouts?
In Arizona. Tucson. They were purchased, and I believe, or they issued from the federal state, the credit institution in Douglas, Arizona, which is no longer in existence.
Yes.
Yeah.
How much is the total face value
of all the certificates? You're trying to see if there's any money here, or if it's all gone.
Exactly. It's about. Let's see. There's one for $5,400, $6,600, $3,800, $45,000, and $6,000. $6,500. I'm sorry. And they all have different times of issue, and they all have different interest rates.
Well, remember in the 80s, the high interest rate.
I mean, all this. If you think of the savings and loans debacle, well, you might not.
He might be pretty young.
Yeah. So, I mean, the savings and loan crisis occurred in the 80s. Arizona was like the epicenter.
Yeah.
At least from an excess standpoint, because the Phoenician was built from money from,
which is beautiful.
People thought they were buying a certificate of deposit at the bank, and they were instead money was going to
my guess. But then I'm going to tell you what I would do if I were you. But my guess
these
is
are all
that
worthless.
These are all worthless because they were issued from a bank that is probably no longer in existence,
and they passed the maturity date. So
and they were probably never FDIC insured. But
it says on the it lists something about the federal chartered. It says for value fully received, Fidelity Federal Savings and Loan Association of Douglas, a federally chartered association. Fidelity Federal promises to pay to the investor's certificate amount together with the interest at the annual interest rate of.
Okay. So how do you?
Date.
So what makes you think that your grandpa didn't take the money at maturity and go do something else with it?
Because my grandfather had he was quite. I mean, he did a lot. We found $20,000 in a box that he had in storage, and I mean he had a lot of investments that we're still finding insurance.
I'd use a lost asset firm.
Yeah.
That's what I would use as a lost asset. So that's a
good idea.
Thank you. You're going to go the other direction.
Because I'm thinking, do you go to a forensic account? I mean, it's so many years ago.
No, you go to a lost asset
and
firm.
a lot of people, unless they've been around that long, they don't even remember.
So here's what happens. There's lost asset firms out there that they make their living out of actually. Typically, they find an asset that they call it a sheeted, which means it's been turned over to a state or local government, normally state.
Okay.
And by the way, you should actually go to your state's website and see if there's any lost assets in your grandfather or grandmother's or parents' name.
Okay.
But you want to find one of these lost asset firms, and you're going to contact them and say, look, we found these assets. They're in my grandfather's name. We don't know whether they're worth anything or not. And they're going to say to you, all right, we'll find out for you, but you've got to sign this contract that you're going to give us 25 or 30% of the value of whatever assets we find.
Okay. I called originally. I had called I traced the successor of the when it closed. The institution closed. It was Chase Bank actually, and then I thought it was Chase. I called Chase, and they said it wasn't. It was since the Fidelity Federal was still open, the main offices were open in San Francisco.
Yes.
So I contacted them, and over the phone they said that it was. They said that it was fine, that there was the accounts were open, they were legit accounts. But then when I went into an office here, after keeping them for a couple of days, they said that it wasn't them in fact.
Yes, that's exactly what I would expect.
Okay.
That's exactly what I would expect. So someone showed up with a certificate at a bank. The easiest thing for the person working at the bank is says, I don't know.
Right. I mean, you're thinking it's not going to be the basic person working at a branch.
Yes. So what you want is a firm that actually specializes in finding lost assets. And like I said,
because this matured.
Yeah.
So the question is, did it get reinvested into something else?
It's probably been sold 2 or 3 times. It may be off the books. It may be on the books. It may have been written down. It may have been
have been spent.
It may have been sheeted to a government.
There was a couple that were along with these, and they were stamped. Two more actually, and they were stamped like they had already been redeemed, but these had not.
Okay, I would still. The way I'd handle it is I'd find a. So go and Google.
But these could have been redeemed.
That's quite.
And your grandpa maybe he didn't find the certificate, and so he signed some statement saying that the certificate
just think about it.
Lost or destroyed.
In the 80s, I mean, you had a passbook where they write your deposits in there. So you want to find a lost asset firm, contact them, sign a contract with them, and I would take everything and turn it over to them, and I'd give them all the information about your grandparents and say, tell us what's out there, and you'll end up paying 20 or 25, maybe even 30% to them. By the way, that number is completely negotiable.
Okay.
And I have friends that run these businesses in California, these lost asset businesses. What they specialize is overseas inherited assets, where someone in Ireland dies and leaves an estate, then they find a U.S.
I keep waiting
counterpart.
for one of those.
Oh, Scott, I have a long history of wealth in our family. We haven't discovered it yet.
Yeah, I'm sure you do.
Anyway, good luck to you, Josh. Yeah, that should take care of it.
Thank you very much. Do you have any recommendations on who I can contact in Arizona?
I would
just Google.
Just Google
we
it.
don't know
So just Google lost asset firms. So,
okay.
Thanks.
Thank you very much. I appreciate the advice.
Sure.
Yeah.
And I've done it for all my kids. I've Googled in the state of California and state of Colorado. Assets. I found some money for one of my sons.
You did?
Like $400 or something. Yeah.
From where? What do you mean you found money? $400?
It was in his name.
From where?
I don't actually remember.
Now I'm getting a little curious. I'm going to look myself up.
I don't remember. I guess we could on a
Maybe
break.
I could find $400. Take my wife to dinner or something.
There you go. You're going to spend $400 on dinner?
No, 2 dinners, 4 dinners, 8 dinners at Chili's. I've picked on Chili's a couple times.
I like Chili's. I like Chili's.
I think the only time I eat at Chili's is when I'm in a restaurant. I'm in a airport, and it's one of the few options.
We eat at Chili's all the time when kids are young. Okay. They're nachos.
My mother's 86, and she gets her treat twice a month is to get salmon. It's not Chili's, but it's a national chain. You wouldn't expect that that's the best salmon, honey.
Like IHOP?
It could be something like that. I'm sure it's frozen salmon.
That's awesome.
from farm. you know. And we'll go to other nice restaurants. Mom, I know you like salmon. Well, no, I like to get it from.
That's so funny.
Anyway, all right, let's continue on here. We're in Oregon.
The guy back there said 17-year-old flipping the salmon.
The frozen salmon. Yeah. It's mostly salmon.
All right, let's go to the next call.
All right, we're talking with Andy. Andy, you're with Allworth's Money Matters.
Hi, Scott and Pat.
Hi, Andy.
I've been listening to you guys forever, and I'm real happy to have a chance to get some advice.
Oh, cool.
Well, thank you.
I'm glad you called.
Yeah. So my questions are around tax efficiency. I have all these investments. I have a little bit of Roth, not much. Traditional and deferred and brokerage accounts. And then there's all these different asset types, and I don't know which ones belong in which accounts. And whenever you do research, you see things like, oh, this particular investment works best in a Roth. Well, doesn't every investment kind of work better in a Roth? So
Excellent
you
point.
have what you have, and you got to work within the confines of where your money is. And I'm trying to figure out, okay, what goes where?
Okay, so we'll start with the basic outline that this is driven by your asset allocation. So, and the reason it's driven by your asset allocation, so if you said to me, okay, McLean, what do you want your equity exposure to be? And I said, 100% stocks, 100% stocks. And you're like, why? I'm like, well, because the market goes up more than it goes down, and over time it'll be okay, and I can live through the volatility. Then it wouldn't matter whether it went into an IRA or a brokerage or a Roth IRA.
Yeah, I
Right?
get it. And it's only recently that, there used to be no alternative, right? And so everything I had was equities.
That's
and it
right.
didn't matter.
That's
but
right.
now that I'm branching out and looking at other things, it kind of matters.
So, Scott, take it from here.
Yeah. So the focus is not necessarily on what your tax return is for 2025. The focus needs to be on what's going to yield the highest net worth down the road.
Lifetime return.
Lifetime return. And as we were talking off break, Pat had mentioned that he had got an email from a client recently that said, my CPA said we need more munis in my portfolio. And Pat and I had a kick out of it. Like, the CPA's never even looked at the guy's portfolio. He has no idea what's in the portfolio.
I've got nothing but equities in his brokerage account, and I've got all his bonds in his IRAs. So putting munis in the portfolio would ruin the whole strategy.
That's right. So
Yeah, actually, I am really interested in the munis. I'm in a high tax state and a high tax bracket. And
that's right.
It looks fairly compelling.
Understand, but if you think about it, let's give us a breakdown of what's in what. How much money do you have in Roth? How much do you have in brokerage? How much do you have in qualified?
Okay, so it's in deferred and traditional, it's 3.9 million. In brokerage, it's about 700,000, and in Roth, it's about 270,000.
All right, and what's your stock to bond ratio?
It's 75% stock, 15% bond, and 10% in cash.
Okay,
and where's the cash?
It's in cash.
No, I mean, is it in the brokerage account or is it in the IRA?
Okay, yeah. The cash it's in the traditional. Yeah, it's spread fairly evenly in all the accounts.
And how old are you?
52.
And when do you expect you're going to start taking distributions?
That is the question. I like working. I don't have any desire to stop working. Probably 10 years still.
Yeah, you got a lot in your deferred accounts for 52. Is that all your contributions or your spouse as well?
That's us together.
Okay.
Yeah.
So if you think about it, people get excited about munis, and there's nothing wrong with munis. But if I'm taking a discount on what the muni pays because the federal government is subsidizing the taxation, why would I hold them at all? Why wouldn't I just have bonds inside of an IRA or a Roth IRA and get that higher return? And that's how you should think about munis, right? which is
if you flip these numbers, if you had $3.9 million in a brokerage account and $700,000 in your IRAs, we would say munis might be a great thing for you. But almost everything you have is in tax deferred accounts.
And what's your approximate family income?
Yeah, it's our AGI this year is probably around 830.
Is that pretty consistent?
No, it's not.
This is a high year for you? Or a low year?
It's a high year.
Okay.
But, and that's post deferral. So I'm like deferring as much as I can.
That's right. So when you look at this, you should have no munis in the portfolio today.
But based on your income in another decade, my guess is you're going to start accumulating more and more in your brokerage.
Mm-hmm.
Yeah, and then at that point in time, you could look at mixing munis in. But remember, these municipal bonds are subsidized by the federal government, which is actually, look, for years and years, the federal government subsidized high tax rate states by allowing the state and local tax deduction.
Yeah.
Right? And you think about it, I hated it when Trump passed that thing because it hurt me directly. But I realized that
I remember talking to my congressman. I said, well, personally, I don't like it at all, but philosophically, I think it makes a lot of sense to get rid of that.
That's right. That's right. So you should have all your highly appreciated assets in your brokerage account and mix the rest of the portfolio everywhere else.
Okay.
You want to have that as highly efficient tax as possible. And again, because the vast majority of your wealth is in tax-deferred accounts, which means you're going to have some fixed income. Until the point you have no fixed income in your brokerage accounts, you're not going to benefit from munis.
Yeah, keep the fixed income.
Not brokerage. I misspoke. The day you have no fixed income in your tax deferred accounts is the day it's going to make some sense to have some municipal bonds.
So, Scott, one of my favorite parts of the show is that segment we call House Calls, where we check in with a caller from the past and see if our advice was sound or ridiculous.
Or crazy. Yeah. And there are times we might be out there. Anyway, in June, we spoke with Amit from Texas. He's not an Allworth client, but wanted to know how to invest the family's money for retirement in a tax-efficient manner. And as we talked to him, we also discovered he had been sold quite a bit of insurance. So let's hear that clip right now.
My wife and I are 40 and 37, respectively. Combined gross income of $310,000 annually from our corporate jobs. We currently have $125,000 in Roth retirement accounts that we converted. That is managed by an advisor that charges 75 basis points, and invested very aggressively in genomics and innovation type companies, showing healthy returns. However, we self-manage the rest of our investments, about another 200 in IRAs, 15 in a separate Roth, all primarily invested in low-cost index funds. We have about 4,000 in a 529 plan for our two kids, and then about 20,000 in an HSA that are all also invested in index funds. I maxed out my
Okay, you didn't mention a 401k in there, or are you going to?
The 401k is part of the 205 that is part of our Fidelity accounts.
Okay, thank you.
We maxed out our 401ks. Well, my wife puts 10%. I maxed out mine.
How long have you been maxing that out?
I'm sorry?
How long have you been maxing that out?
For the last 2 years.
Okay.
We consistently save about 15 to 20% of our net pay from our corporate jobs. And then beyond that, we own two daycare businesses. One is operational that we are expecting to see about $120,000 annually going forward. Second one's under construction that will, once it's fully operational, we'll get about $150,000 from that. And then my wife will manage that at a $65,000 annual salary.
And is that where your cash has gone? Because you make a relatively good wage, and you don't have a lot saved relative to what your wage is.
Correct.
Is,
The majority of our cash went into putting the down
Got it.
payment in for the new business, which was
Yep.
around a little under 300.
Got it.
Do you own the property or just the business?
The first one we owned, both of them were going to own the property and the business.
Okay.
So we have some concerns, particularly regarding our VUL policies that we have with our current advisor. We were sold that given our income, we would be phased out, and this would provide you with an opportunity to put more money, almost Roth-like. We do the VULs.
It's variable universal life for the rest of the
outside
listeners.
of the cost of insurance. All of that goes into S&P 500 index, and we fully participate. We're not capped, and there's not a floor. We're worried about the high fees that our current investor is charging, along with just the high fees related to VULs.
Yep.
Our goal is to build a legacy for our children, as well as save for their college and weddings at some point. So my questions are: one, are these VULs truly beneficial, or is that money better deployed elsewhere given our concerns and our goals? The second question is, should we consider switching advisor to somebody that's a little more proactive from a tax planning perspective and keeping track of our goals?
You refer to these corporate jobs. Your wife works for a large corporation now?
She works for a marketing consulting company, and I work for a renewable energy company.
And what is her income now?
She makes about 95, and then I make about 180 plus my bonus.
And then you mentioned that she's going to leave that and just run the daycare at $65,000 a year. Is that correct?
She's going to keep both.
Okay.
She'll manage, we'll hire directors, but she'll be there from an owner perspective.
Okay.
The plan is to ride both of them as much
By
as
the way,
possible.
wealth is created not in passive financial assets like S&P 500, 401k, VUL. Wealth is created in your career. Either you're very talented and somebody pays you a boatload of money, or you create a business.
Or in your case, both.
I mean, if you look across the spectrum of wealthy people in this country, it's very few it's inherited. It's primarily in your career, either a business or you're really good at what you do.
What did you say was in the 529 plans?
Let me rephrase that. You're really good at what you do in an area that demands a high wage, because you might be a great violinist and you bring a lot of joy to people's life, but maybe you're not making
Yeah, this follow your dream stuff is garbage.
Well, I don't know, garbage.
Okay,
You need to get paid too.
the 529
The
plan.
intersection between getting paid and your dreams.
Well, how much is in the 529 plan?
About 4,000.
Okay, and let's dig into this VUL.
Yeah.
What's the
So, first of all, variable universal life policy, the way they're structured, like Pat and I both started in the industry with a life insurance company, 1989 and 1990. We lasted a couple of years. We learned that if you get trained in the life insurance industry, they teach you that life insurance is the solution for any financial issue you're dealing with. I don't care what it is, a life insurance policy is the answer, right? That's how they train all their agents and whatnot. A variable universal life policy is a policy where you put money in to this pool. You can choose how it's invested. So you've chosen to put it in the S&P 500 fund. And then there's a cost of insurance. There's a life insurance, like a death benefit. And how much is your death benefit on your policy?
For the parents, it's 500,000. For the kids, it's $1 million.
Wait, whoa.
How many policies do you have?
Each of the family members have a policy, and then we as parents also have a separate $1 million term policy.
Okay, and is it the same advisor that sold you this that is actually managing the Roth IRAs?
Part of them, yes.
Yeah, the one.
rest of them I
Okay,
manage.
so let's break down all four policies. When did you purchase these?
Well, let's explain how these work.
Okay, well, thank you.
$500,000 a death benefit on Amit's first policy he's talking about here. And so if there's no cash in there at all, he has an insurance cost of whatever the insurance cost would be for $500,000 of death benefit. If he had 100,000 of investments and cash in the policy, he would pay the amount of death benefit would be the difference between that 500,000 and what he's got saved there. The cost, my experience, the cost by looking at the cost of insurance on these policies, it tends to be a lot more than it would be on pure term insurance.
Yes. So what they call that difference the delta pure insurance, and that pure insurance is expensive. And once you're in, you can't requalify because they have big surrender. Most of them have big surrender charges.
Plus, there's the internal costs are 2-3% a year.
There's a load on it typically, and then there's a management fee inside.
Now, the benefit, what they sell, the benefit on these is they grow tax deferred, so you're not taxed at all as things grow. And then when you die, that's tax free. But if, later in life, you can withdraw your contributions first, your policy premiums first. And then after that, you can take out a loan against the policy.
And as long as you die with the insurance policy in place, it's tax free. The problem is most people don't die with these insurance policies because the costs actually erode most of the value in there.
The whole concept of using these policies, funding them, and then in life taking a withdrawal, I can't tell. I've been doing this 35 years. I cannot think of one situation where I saw someone with a sizable nest egg in a life insurance policy living off the loans from it.
Well, Scott,
I've seen where they're about to implode. And and if they collapse on themselves before you die, suddenly it triggers a massive taxable event.
You said you and your spouse each have $500,000?
Correct.
And what's the cash value in there?
The cash value for mine is around 65, and the cash value for my wife is around 20.
And how much are you putting into these?
Right now, we're putting $500 a month for each person.
Okay. And you then mentioned that you had 2 policies, one on each child?
Correct.
And what's the face value on those?
They're $1 million, and we're putting in $300 a month for each child.
Holy smokes! Look, whatever.
How much cash is in those?
My eldest has a good amount, a little north of 30, and my youngest has been recently born, so he doesn't have much. My
experience has been the internal cost of the insurance is more than the tax liability would be.
And why would you buy an insurance policy on a child?
Because it's such a great tax tool.
But the 529 is completely ignored in this equation. There's $4,000 in the 529 plan, and they're putting $300 a month into these policies. Here's what I think you should do. Cancel the policies on the kids immediately and consider it sunk cost. You're going to lose most of the money, or you could actually...
I don't know what it costs. There's a minimum cost every year.
That's
for
right.
These things.
So, but what we do
you
know,
got to kind of run the numbers.
Is the newborn you should cancel it. The child that's got a $30,000 cash value, you might want to lower the face value to $100,000 or maybe $50,000, and that way you're buying less pure insurance, and then slow down or stop the deposits completely. But I was
trying to see what the lowest death benefit I can get to without it not being an MEC.
Oh no, you don't care if it becomes a MEC.
Okay.
You don't care. You don't care because the cost of insurance it far exceeds any of the downsides of becoming a modified endowment contract.
Okay.
So just throw that away. In fact, even on your own life insurance,
you might want to qualify for some more insurance before you reduce.
I'm talking about the kids first.
Oh yeah.
Okay, so the kids. So you're on the right path. So don't just see what the lowest face value you could turn those things into.
I would look at if the surrender charges aren't too astronomical, I would just cash the thing out. It's $30,000, a couple grand in penalties. Take the $28,000, throw it in the 529. That's what I would do.
That's right.
And if you really want life insurance, I don't know why you'd want life insurance on your kid, but if you want life insurance on your kid, go buy some cheap term insurance.
You have no need for life insurance on a child. Unless this child is some sort of prodigy, is making all kinds of income that's coming into the family. Life insurance is designed to replace
Well, the
income.
amount of money we're spending on them, I expect them to be projects.
Okay. Well, I don't know. I don't actually know.
Wait till they're teenagers.
I don't know if that's how prodigies work. I don't think you could actually spend your way to a prodigy. So on those, I agree with Scott. I'd look at either collapsing those policies completely, or at least the oldest one child turning into a mech. Your policies, I would turn them into mechs. First of all, I agree with Scott. I would actually go out and buy some term insurance. And by the way, $500,000. How much other term insurance do you have?
He's got $1 million.
Other
$1 million for each of us.
Yeah,
that's not enough.
I would have at least $2 million.
Yeah, that's not enough.
Okay.
Yeah, $2 million of term, and if you're in reasonably good health, you're 40 years old. It's cheap.
So for both those policies, your policies, I'd either lower that face value as low as I possibly could and turn it into a modified endowment contract, or cancel them completely and just take the hit. The 529 is the thing that you missed. I mean,
Well, he didn't miss. He's followed this advisor.
okay, the advisor missed, and the
No, the
reason
advisor didn't miss. The advisor had a misalignment of his economic. I'm assuming it's a male. His economic benefits compared to Amit's economic benefit. There's a misalignment. He earned a commission.
That's right.
How can you be open-minded and actually look for the best solution when you've got this conflict, tremendous conflict?
Oh, Scott, I disagree. I kind of disagree. If he had done every other thing, let's just say that he had $2 million in the right.
Whatever.
Right. Let's just say we went through the list.
He's either uneducated and doesn't understand the other stuff. He's an idiot, or he's unethical. My opinion.
Or maybe all three. But the VULs are the very last thing on the list of a product that you should use. Very last thing, right? Everything else. The 529 should be fully funded.
Look, with the tax efficiency of ETFs and a synthetic index by a direct index, like why? Those are such.
This is, as I said, the very last thing. After you've gone through every other thing, you're not there. So your idea, Amit, of either
Look, he followed advice.
Understand? That's what he's calling for.
I understand.
He's calling for outside advice.
I just feel bad.
But I don't have a dog in this fight. So the 529. Look, you can convert a 529 plan to a Roth IRA if the child doesn't use it. And you talked about legacy. So these 529 plans should be maximum funded, right? All the way.
Should I have one for both
No.
or one total?
You can't. You have to have them separate.
I have two, and what I would do is just how much is it going to cost to go to education? Work backwards. How much do I need to save on an annual basis?
Right.
So bring those things to zero or turn them into max. Get $2 million term life insurance policy, 10-year level term at least on you. Fund the 529s to the maximum, and I would actually make them. I'd make them aggressive. Your wife should increase her 401k to the maximum, and you're doing the backdoor Roths. We can see that. I think you're doing great. I think I would clean that up, and I'd get another advisor.
Okay, so I just need to fire my advisor and stop paying him. That's what I need.
That's
to
what
do.
I would do.
Yeah. Give it some.
Is he affiliated with an insurance company?
He is, yes.
Yeah. Yeah. So all you got is a hammer. Everything looks like a nail.
Well, I'm getting ready to pull my hammer, so.
Amit, thanks for joining us.
Yep. Welcome back to the show.
Yes, and please bring us up to date. So.
Hey, guys, can you hear me all right?
Yes, sir.
Yeah, so we did kind of incorporate the things that you've told us. The previous advisor, we kind of told him to kick rocks. And we opened up the 529 plan, started putting those in there. Given the amount that we had specific for my daughter in her VUL, we lowered the death benefit to as low as possible. So we're not paying for a a lot of cost of insurance.
And just out of curiosity, in running the numbers, you said you kicked your other advisor to the rocks. I hope not physically,
Yep.
but how did you crunch the numbers to see what was best? Did you just do it by yourself, or was there someone else who understood how these policies work in great detail to help you, or what was that process like?
Yeah, so my employer has. I reached out to the benefits provider, and he also has his own business, and he kind of provided some guidance. Didn't charge me at all. And,
Beautiful.
He said, given the amount that's in my daughter's, it probably is best to kind of go with that route, and then just max out the 529 at a level that you feel comfortable with your with your kid's future education, so you're not paying for insurance you don't need, and you're not paying somebody else their bonus.
And how low were you able to get that face value on your daughter's policy?
$250.
And that was as low as they thought was reasonable?
Yes.
Well, nice. I mean, he was talking to someone that had no skin in the game, right?
Well, yes.
Right.
And did the advisor that you talked to through your employer, did he feel the same way we did?
He provided similar guidance, yes, in terms of, you don't need this for your kid. There's better ways to optimize how you use your capital to kind of grow and invest for some of the things that you want to do for your children and a legacy and things like that, and yourself.
And I'm sorry this happened to you, but for the rest of the listeners, life insurance policies are sold as if they are simple, easy investment vehicles.
Yeah, and it's got to tell you. So Pat and I listened to this clip before the show started this morning, and after your previous clip, after the clip, Pat says, "This stuff is really complicated," and he says, "Can you imagine if the average person called a stockbroker from," and he named one of the big firms I'm not going to mention, and he said those guys would not have a clue how this stuff, and it's probably fair, just because. And one of the reasons we started in the industry 35 years ago, at the first couple of years of our career, was out of life insurance companies. We learned the strategies the sales strategies that they employed to sell policies, stuff like this, like, oh, you have a kid, let's just get him $1 million life insurance.
The interesting thing is we didn't do very well there.
Well, no, because we kind of saw what was going on, and it wasn't a good fit.
Yes. And so what did you end up doing with your policies?
We did the same thing. But we also got an extra $1 million for each of us in term. So we're not, we have that covered, and hopefully, by the time our kids turn, 20 and or go to college, and they'll be set in terms of, their 529s. And if they don't use it, that's great. We'll convert it to a Roth and give them a legacy that way. But I think we have the infrastructure in place to kind of not have to worry about this stuff going forward, hopefully.
My guess is the legacy you leave your children will what you do with them on a day-to-day basis.
Oh, of course, that's always a bigger one, of course.
More so than the money. Off topic. Did you guys open the second
Daycare
yet?
We just received permitting for fire yesterday, so things are moving relatively quickly now.
Awesome.
Hopefully, we'll close on the loan and then begin construction.
Congrats.
Good for you.
Anything else we can answer today?
No, I think what you kind of helped me with from a thought process and how we should think about structuring this kind of laid the foundation. And now I'm trying my best to kind of be wise with my money as my businesses kind of grow. We'll probably at some point need to. I did hire a separate CPA as well to kind of help tax plan, not only for the future, like next year and things like that, with what's going to come from the business in terms of upfront depreciation losses and things like that, and how we can maybe take advantage of potential conversions and things like that. So, but as the complexity of my finances changes, at some point we will probably need a financial advisor to start thinking about how to strategically take advantage of whatever laws may get passed from now until then. I know direct indexing is something that I'm probably start getting a little more educated in. Right now, I just don't have a lot in the brokerage.
Yeah, I know you got your
account.
business. Well, here's the difference.
Exactly.
So you're talking about a direct index. You're talking about that's a strategy of owning a small stake in businesses that other people started. You're instead taking the money and putting it in a business that you're starting.
Right.
Well, obviously, you start a business yourself. There's more upside. There's more risk as well. But I mean,
in this business, is just a bit of advice from someone who Scott and I have opened multiple businesses,
and
together,
some of them successful,
and some of them that we still talk about. Don't be afraid of getting too large of a cash cushion.
I do have about 9 months worth of expenses. Probably closer to probably a year. If things go sideways, we obviously would probably cut off some of our children's daycare expenses and things like that. But if I had to guess, probably a year. I guess I did have one question. In terms of thinking through the next, potentially 15, 20 years, what are your thoughts on thinking about creating passive income through whether it's dividends or something else as I get older, as my wife and I get older?
I would say focus more on creating net worth, and then whenever you need income from it, then figure out the best way to generate income.
That's correct.
As opposed to the whole concept. What, you're going to buy fixed income to have guaranteed income?
Or high dividend stocks?
Treasuries or
But
something?
if you think about it, if you can dial 2 daycare centers, my guess is you could dial 4 or 5.
We're doing 4.
Or 8 or 10.
And then you don't have to worry about passive income, because then at some point in time, you got a massive asset that someone's going to cut you a big check for.
Yeah. And the idea of actually owning the properties, which you did already, and then leasing back to yourself is a form of passive income. And then if you sell off those daycares at some point in time, normally what you would find is that you'd probably end up keeping the properties, and that becomes a form of passive income in retirement.
Yeah, and lease them back to the
And
new
you
owner.
lease them back to the owner. You sign a big lease before you sell them.
Because a big operator is probably not going to want to own the real estate.
Most of the time, they
right.
do not. They don't want to own the real estate because it's not what they believe to be an efficient use of their capital. But it might be the greatest use for your capital.
Rather than
in
become a
retirement.
student of how direct indexing works, continue to be a student of this industry that you're invested in. Yes. So you go from 2 to 3 to 4 to 8 to whatever, if that's what you want to do. But in talking to you, if it's you want to create family wealth, that would be the way to do it.
Yes. Yeah. And obviously, if your wife's working both her regular job and in the daycare, she sounds like she's pretty motivated, or at least you might be motivating her.
I'm probably motivating her. We'll see how it plays out in practice. She might be like, "I'm done. You take over." Or, hey, she might quit, or she might. Yeah, we'll have to figure out how that works. But
well, it sounds like
I do think that lease these things are very capital intensive, and we own 2 of them. And if we feel like we're always on edge because we're dropping all of our savings into the next one,
you're investing. You're investing in them. You're converting from savings to an investment.
Fair point.
Yeah.
They are capital intensive, so we might look at we own 2. Does it make sense to maybe start leasing? But we're going to have to run the numbers in terms of what the rental rate is and things like that.
Correct. Or enter into lease options to buy, which allow you to actually develop the properties. And so the problem with not owning them and actually signing short-term leases on others is it's really, you could call it a daycare center, but really it's a retail space that people bring their children to, and they get used to it, and it becomes a brand. And the problem with not owning, or
It's a little
at least
different than an
getting
office
long-term-
building that's on floor 5 in a building.
That's right. They become their own personalities, if you will. And the location matters. It really, really matters. And so what you don't want to do is sign a short-term lease and then get priced out of that particular location as you've built up a following.
Suddenly a mile and a half away.
Yeah, we're looking at 15-year lease with 2 5-year options with a first right of refusal after year 3, which is typically when we ramp up to capacity.
That's actually that is a decently long lease.
That's a long lease. Then you got to ask yourself if you want that personal guarantee for 15 years.
Yeah, and are there outs in it?
But the plan is not to be involved. The plan is to structure a management team that kind
I
of
understand.
runs the day-to-day.
Oftentimes, when you have a small business, the landlord will say, "That's great. I'm sure your business is going to do well, but we'd like a personal guarantee." So I'd be really careful. Personally, I would not want to sign a 15-year personal guarantee.
Got it.
I would try to negotiate something. I'm happy to do it for 3 years or something like that. And then, yes, unless it's managed by some massive REIT or something like that, the landlord's going to have, every lease is different.
Yeah, and just remember, you sound like you're an engineer by education or computer science, somewhere along those. Right?
STEM.
I'm a CPA by trade.
Okay. All right. So as I always share with my kids, I said everything works perfect until you involve people. The spreadsheet was beautiful. Right. So just remember that.
And wish you well.
Yeah. Congrats. You've done great.
Amit had someone he was working with, a financial professional he was working with, wondered, is this really the best? Reached out to us, got a second opinion, then went to somebody else, got another opinion, and with a little bit of advice and changed course. So if you've got something in your financial life that you're kind of thinking, is this the best for me? Get a second opinion, whether it's from another advisor or this program. Before we wrap up, I want to let everyone know about, we've got a webinar, Wealth Building Beyond Wall Street. It's exclusive insights reserved for the affluent investors. So Victoria Bogner, our head of wealth planning, is doing this. It's going to talk about why today's 60-40 portfolio falls short for multi-million-dollar portfolios, which non-public traded strategies may help generate tax alpha and yield, how sophisticated allocation in non-traditional assets can support multi-generational wealth goals, and more. This webinar is not really for everyone by design. The discussion is tailored to investors managing 5+ or more in investable assets, so $5 million or more. The webinar is Wednesday, October 15th at 10 a.m. Pacific, Thursday, October 16th at noon Pacific, Saturday, October 18th at 9 a.m. Pacific, and register and all the other information at allworthfinancial.com/workshops. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.